But there's some more good news according to us, and that is with regards to the latest directive coming from the PPRA about the handling of trust account interest on trust accounts. And with that, I would like to invite in Tatu Ramadi, and she's joining us to help us maybe just clearing up some confusion with regards to the PPA, the interest handling directive there, as well as the reason for a latest directive on trust account interest. Tatu, good morning. You are very busy. I've seen you on different platforms throughout the week in different areas in South Africa. First of all, thank you for making time to join us. We really appreciate it. And yeah, you guys play a critical role in industry to help us to shape the future. And your voice today really means a lot for us. Thank you for joining us.
Thank you. Good morning, Johan, and good morning to my fellow speakers. And thank you for WeconnectU for inviting me and inviting the PPRA. And then good morning to everybody on the call, all property practitioners and stakeholders who have joined us this morning.
Tatu, we've got an easy job to do today. We need to clarify or demystify this handling of trust account interest. So I'm going to open up by just maybe recapping where we were before the PPA came into place. Then give us just a reminder what the PPA said, and then I'm going to hand over to you just to maybe demystify for us the challenges that the market are having to understand where we are heading. So first of all, I'm quoting a Q&A document published by the Estate Agency Affairs Board Act, really about how do we deal with interest on trust accounts and what is due to the fund and what is due to the agency. Now, not without reading the full paragraph, in a nutshell, what the PP or the EAB at the time said is all interest earned on either the Section 32(1) and Section 32(2) accounts, which have not been specifically nominated for the benefit of a contracting party, in our case, a tenant, is due to the Estate Agency Affairs Board Fund. Agents must disclose to parties precisely where interests are going, and then if any interest was not paid out to a tenant or landlord or investor, then at the time of paying over the full amount to the Estate Agency Affairs Board Fidelity Fund, the agency could retain 50% of the interest. Okay. I think that was quite a well-accepted, well-understood principle, and I think it was also well implemented and adopted without industry. Then came the new PPA in February 2020, and the wording was a bit different. So I'm going to just focus on the paragraph number 2, which really said that before money is received, it must be mandated where the interest is going. And then there was this really confusing part to say that interest may accrue to the Property Practitioners Fidelity Fund. And I think within that little word may, we found quite a big challenges or the market to understand that. So maybe at this point, just give us the thinking process behind difference between the Estate Agency Affairs Board Act and how it read with regards to interest, and as well the PPA and the thinking behind that. Over to you.
Thank you, Johan. So firstly, when the PPA was promulgated, before it was promulgated, it was open for the public to make comments. But came February 1st, 2022, it came into promulgation, which meant that now the erstwhile EAA, right, was repealed, and we had to now enforce and implement the new legislation before us, which was the PPA. Now it's funny now, Joanna, that you read that section, and we know that with any legislation, it's open for interpretation. You know, the words such as may, must come into real play, and the legal minds on the forum can attest to that as well. But the gist of it, Johan, is that in the erstwhile EAA, we know that it was straightforward. Interest earned, 50% had to come to the regulator, and 50% had to go to the property practitioners. But now, in this new dispensation under the PPA, it was silent, right? And I think that's what caused the most confusion. And hence now we had to send the directive. And the purpose of this directive around the handling of the interest earned on trust accounts, and I think that's the basis of why I'm here today, is to clarify that all we're saying is that the interest, the treatment of the interest earned on trust accounts and not covered by express written mandates, the status quo remains as it was in the erstwhile Estate Agency Affairs Act. So all we're saying is that we are going to read this as it were in the Estate Agency Affairs Act. So the interest earned does not accrue holistically to the PPA. I wish that was the case. And I think that's what caused most confusion. But because, in all honesty, is that we are a self-funded entity, but the heart of where we are was not to take away monies or take away everything away from the property practitioners. We are saying that if there's no expressed mandate, if there's no mandate that articulates and expressly states that the interest earned must go to the practitioner, to the landlord, we are saying that the status quo remains. 50% will then come to the regulator and 50% will go to the property practitioners. And that's all we were trying to articulate in that directive that was issued.
Doctor, thank you very much. I've brought up that little section about those paragraph 6 and 7 while you were talking. So first of all, another new thing that came into about is the fact that banks will now report directly to the PPRA, but it doesn't take anything away from the auditor that should still declare all interest earned on trust accounts, which obviously, well, first of all that, and then also which was not mandated to go to other tenant or investor. So that's the first section. It's important to note of that the banks obviously reports directly to the PPRA, but it doesn't take away any obligation from the auditors to still make sure that they submit in the audit report all interest earned on trust accounts. I think the confusing part of the directive was in 7.1, where it reads, having audited a trust account as contemplated in section 54(1)(a). I think people thought, well, in that case, they only referred to the section 54(1) trust account. I think we all know that the section 54(2) account is part of that audit, but it doesn't specifically mention that. And I think it's important just to highlight what you said. It should read the same way that the South African Affairs Board Act read with regards to it's referring to both 54(1) and 54(2) interest. So whatever interest in those two accounts were not mandated to go to a third-party tenant or investor, the remainder of that is then split between the PPRA and the agency at the 50-50 basis. Am I correct in just confirming that statement?
You're right on the money, Johan. And I think just for the purpose of all those who on the forum who don't understand what 54 subsection 1 and 54 subsection 2 means, basically they are both interest accounts, right? The only difference is that 54 subsection 2 is an interest bearing trust account, or rather a trust account for long-term deposits, but the treatment is the same. So you are right on the money on that one, Johan.
Right. Again, just last question, Todd, to mandate. It's obviously referred to you a couple of times. So basically, our clients must ensure that within the lease agreement they sign with tenant and landlord, that the way the interest is going to be dealt with will be disclosed in that lease. Is that referring to the mandate?
Yes. Well, it refers to when I spoke about the express written mandates, right?
Yeah.
As
Yeah.
the rental is concerned, yes. But in terms of whether the interest is mandated, I think we need to separate the two. That's a different story altogether. But on that, Johanna, I want to say that there is no mandated interest, right, that a property practitioner can earn. However, property practitioners are only entitled to retain 50% of the interest earned on trust monies that are not covered by these express written mandates. And that's what you alluded to. So if it's not in black and white on how this interest should be treated, which I think it's important just so that we all cover our bases. If there's ever a dispute, you can always say, no, I was entitled to 50%. which I did, receive or earn, and then the 50% I did hand over to the regulator. However, if the express written mandates have a clear provision on the party entitled to the interest, then the interest should be paid to that party, and the 50-50 split will then not apply, right? So if we written in that express mandate that Mr. Landlord or Mr. Client is going to get 100%, then that would mean the practitioner loses, the regulator loses, and what will take precedence is what is contained in that express written mandate.
Datu, I think we could not make it clearer. Thank you very much for your time today. Thank you for clearing it up for us. And I really believe it's really good news. I think over the last 2 years, there has been a lot of confusion. It has been a key income stream for clients, especially looking to cover some administrative fees on these accounts. So I think it's really good news for industry again that income stream can maintain, again, abiding by the legal guidelines as Tatu explained. But Tatu, thank you very much for your time. I know you've been traveling heavily this week, so maybe it's time you can go home now. Take a long weekend. But I'm sure you would like to listen in a bit longer. So thank you for joining us. Appreciate the time, and thank you for helping us to clarify the misunderstanding with regards to this.
It's a pleasure, Johan, and I appreciate these forums because we give stakeholders an opportunity to hear firsthand from what we're saying. And I think sometimes when we express certain things verbally is different than when it is written, because then that's open for interpretation. So I'd like to thank you for giving us an opportunity to come in, reiterate what we meant by that directive. And I will be staying on. It is a Friday, but there's no half days at the PPRA. Well, for me at least. So I will be sitting in and listening in on all your other speakers. So thank you so much, Johan, and the WeConnectU team.
I'm just going to confirm what we discussed, because even after our discussion, there's still questions coming in about this interest on trust accounts. So for everybody who asked that question. So basically, in layman's terms, when the money is received in a 54-1 trust account, that trust account does earn interest. Typically, a 54-1 trust account, it's money in transit, because that's where you all do all your receipting and payment out. So typically, the interest earned on the Section 54.1 is typically non-mandated, because a tenant and a landlord typically would not expect any money or interest to come for them while money is in transit in the 54.1 trust. The 54.2 trust is typically where you would take your tenant deposits for the longer term investment. And typically, as per the Rental Housing Act, tenants expect interest on those deposits. I think the most important thing that Tatu explained today, in both cases, it must be clear to who the interest is accruing, irrespective of 54.1 and 2. If it doesn't specify to who the interest is accruing, then the interest ultimately is accruing to the PPRA, and you can retain 50% at the time of paying over. If it is specified as per mandate or lease where the interest is accruing to, then the interest must obviously accrue to that party. I think that is precisely what Tatu said, and I think that is hopefully clear. It means that if the agency are getting interest on a 54.1, which they should, then half of that typically, because it's typically non-mandated, would go to the agency, and the other half will go to the PPRA. If somehow you have disclosed that, let's just say you earn 5% interest on the 54.2 trust, and you pay out 4% to your tenant, the 1% will be shared between the PPRA and the agency. As long as it's mandated and there's full transparency about that, and the reporting must be in line with that on both what the banks report to the PPRA with regards to total interest earned, and what your auditor reports to the PPRA with regards to total interest earned, what is mandated and what is not mandated. Any additional comments above that, Tatu?
No, I think maybe we can take it a step, well, you saying just putting it in layman's terms, but I think sometimes, when people see numbers to illustrate it further would assist. So maybe, Johan, I would suggest let's take it there, saying you've deposited 10,000, the interest accrued is X, and then let's,
Okay.
just practicalize
Right.
it.
Let me do it again. A nice challenge. All right. You have received 10,000 Rand. You've received 20,000 Rand in your Section 54(1) trust. At the time of receiving this monies, half of that money was for the tenant deposit. So you move 10,000 of the 20,000 to the Section 54(2) account. The other 10,000 you pay over as rent for the landlord or investor over to him by the second, third, or fourth of the month. While that first 10,000 Rand, the rent, lies within the 54(1) trust account, that 10,000 Rand will accrue interest. Let's just say it accrued 2 Rand interest in the time. That means that typically the Section 54(1) trust interest is typically non-mandated. What that then means is 100% of that 2 Rand is payable to the Fidelity Fund, but you can retain 50% of that. So 1 Rand will go to the Fidelity Fund and 1 Rand will stay with you as agency. Then the other 10,000 Rand went into the Section 54(2) deposit. Again, just for explanation, you receive today 7% interest on that trust because you obviously pull the money with a bank. It is typically a lot higher than an individual tenant can receive at a bank in a normal savings account, which is just saying today's terms 5%. It means there's 2% that is not being mandated to go to the tenant. And then of the 2%, whatever the amount is, 1% will go to the PPRA, Fidelity Fund, and 1% can stay with you as an agency, as an income to cover typical banking fees and audit fees.
If that's not clear, then you need a master class.
We will have a separate master class about it, but
just on that item. But I think it's really, I think it's clear how you just articulated it, Johan.
It was a good maths class for me. Thank you for challenging me like that.